Right, so WeWork is a stock that is in focus. In fact, that stock was up in a way 8% in trade today. That has cooled off from there, but nonetheless, it is still in the green, trading with gains of almost 3.5%. To weigh in on this note by Jefferies that's giving a positive stance on WeWork, we now have the management. Karan Virwani is the CEO and MD of WeWork India joining us. Hi, Karan. Good afternoon, and thank you so much for joining us today. Karan, your stock is in focus after a really bullish brokerage note from Jefferies today. Jefferies is expecting a 22% revenue CAGR and a 28% EBITDA CAGR through FY28. Now, along with adding of 15 to 20,000 seats annually. Now, I do see that you are well funded for expansion. How aligned are you with these expectations?
Aligned, if not, looking to try to go over and above that. But, the sector is doing really well. The overall market has been extremely strong. Commercial leasing, has grown drastically just in the last 1 year. Flex penetration continues to be high. Our revenues have grown nearly 20% in this last 12-month period. In the last quarter, our EBITDA margin has reached close to about 20% and a 40% quarter-over-quarter growth. We're at about 120 crores of EBITDA for just Q2. So I think we're very much on track on those growth numbers, and we're seeing actually more tailwinds, hoping to see a better FY27 even from this year, and then even a better FY28.
Understood. So the outlook is very positive, and Jefferies also is very positive, and that is the reason the stock is spiking in trade today. But since we are talking about results, second quarter revenue and EBITDA growth was very solid, but net profit declined sharply. If you can take us through what led to that?
Yeah, I think that there's a big clarification needing to be made on that, and it was, sort of reported maybe a little bit wrongly. Last year in September, before we filed our DRHP and while we had to close the financials, we sort of took a deferred tax credit of nearly 200 crores, which was showing up in the profit of last year. But if I look at just the operational profit, last year, quarter two was negative about 34 crores. That negative 34 crores has actually become a positive 6.5 crores in this quarter. So actually in 1 year, we've added close to about 40, a little bit over 40 crores of actual net profit in the business operationally without taking any of this accounting tax credit. And we only had to take that because of the accumulated losses that we've had over the last few years. Really, the business has actually moved drastically from a PAT perspective. I mean, just quarter over quarter, PAT has grown almost 3 times. And from last year, we've added almost 40 crores of PAT into the business operationally.
Right. Karan, also with occupancy improving to 80%, what demand signals are you seeing across cities, sectors, and even client cohorts?
So across all cohorts, we're seeing huge demand. If you look at our sales velocity, actually just year over year has grown almost 60%, which is just a true indication of type of velocity and the type of demand that we're seeing. GCCs are driving a big part of it. GCCs are nearly 35 to 40% of our portfolio now. We are also seeing, Indian corporates actually starting to adopt the model in a much larger way. So Indian companies themselves are growing across the board. And slowly we're starting to see some VC funding coming back into startups. And that is also going to drive, a big part of that growth, because largely that funding goes into hiring more people or, the organization itself growing. We've seen almost 50% of our sales come from internal members itself growing, which shows you the value proposition, of the platform and the stickiness of the member base, where almost half of our sales just comes from the internal members expanding and taking up more space.
Understood. So that's as far as your expansion plans and the domestic market demand environment is concerned, which you're saying is very positive, especially because of GCC. But if you can take us through the numbers. So Jefferies is penciling in 22% revenue growth for the next 3 years on a CAGR basis. Is that too conservative, or would you concur with that view of estimation?
I would always stay on the more conservative side of what we would want to project. Our endeavor will obviously be to, at least grow at the industry benchmarks or slightly over than that, because we're the market leader and we want to take more market share of the industry. So the industry is growing roughly at about 20 odd percent, 21%, and we've already delivered slightly higher than that growth for last year. So I think that that's a consistent type of growth number that we'll be looking at. More than the top line growth, we're very focused on the bottom line growth as well. So slightly higher than that EBITDA growth targets, are what we're sort of trying to get the business to move to, and we're well on track for that for this year.
Right, Karan, also the international clients form 62% of your base. Now, based on the interest that's coming in for the GCCs right now, how will the mix between the domestic and international clients look like going ahead?
I think that, I think it'll sort of hover around the same levels. If you look at who are the biggest employers in the country today, the biggest employers continue to be your multinational businesses and now some of these GCCs. The kind of numbers or headcount that they are adding in India continues to increase. The cost arbitrage that India has continues to be relevant as the rupee devalues. It continues to be cheaper for American businesses or even European businesses to keep taking real estate and keep hiring in India. And while that cost is coming down, the quality of talent continues to increase in India. The amount of output that we're delivering here continues to increase. So I think international will still hold a bigger chunk of our portfolio. And because we're more on the premium grade A side of both the quality of space that we take as well as the assets, these tend to be the locations where a lot of these multinationals and Fortune 500 companies want to grow, which is also why we've decided to focus our growth there. And so you will see obviously a more majority towards international even as the months and years progress.
Right, so the outlook continues to remain very positive. The market size is huge and you're looking to expand across geographies, even with respect to international business. Thank you so much, Mr. Virwani, for taking your time out and joining us here on ET Now. But